Something really strange is happening in the global silver market. And I don't mean the usual day-to-day bounces. We're seeing a bright red warning light flashing on the dashboard of the financial system, signaling a deep, fundamental stress in how we price one of the world's most critical assets.
And here it is. This is the core of the mystery right here. Get this. In Shanghai, the price of silver recently shot up to $85 an ounce. But at that exact same moment in New York, the price was hovering around $79. That's a $6 gap for the exact same thing. That's not supposed to happen.
Okay, so you might be thinking, a few bucks, who cares? Well, it matters a whole lot. A gap this big, this persistent, isn't just a quirk. It's a signal that the entire pricing system is starting to crack. It's telling us that the value of a paper promise to deliver silver is fundamentally decoupling from the value of holding a real, physical bar of it in your hand. And that changes everything.
So, first things first, let's break this down. Section 1, a tale of two prices. You've got to understand the fundamental difference between these two markets because it's the key to this whole story.
Here's the deal in a nutshell. Shanghai is a market for the real stuff. When you buy a contract there, the expectation is that you are taking delivery of actual physical silver bars. The New York COMEX, on the other hand, it's mostly a paper casino. Something like 97% of contracts are just settled in cash. It's a market built on paper promises, not physical metal.
And what that really means is that the Shanghai price is telling us what people who actually need the metal are willing to pay. And they're willing to pay a massive premium for it. The physical world is taking back control, and it's making that paper price you see on TV pretty much obsolete.
All right, so now let's talk about the trigger. This stress didn't just pop up out of nowhere. It was exposed by a single, shocking event deep in the plumbing of the financial system. Which brings us to Section 2, the $17 billion emergency signal.
So, picture this. The setting is what traders call Ghost Week. It's that dead quiet period between Christmas and New Year's. All the big shots are on vacation, skeleton crews are running the desks, all the market's usual shock absorbers are just gone. It's the most vulnerable time of the year where any little tremor can turn into a full-blown earthquake.
And right in the middle of this ghost week, bam, this number appears. Over $17 billion. In a single morning, major banks ran to the Fed's emergency loan window for that much cash. And no, that wasn't a typo. It was a massive, flashing red signal of extreme distress.
Now, to really get how serious this is, you have to understand what this market is. This isn't where you go for a normal business loan. This is the financial system's emergency room. It's the pawn shop of last resort. For a big bank, going here is the ultimate walk of shame. It's a public admission of weakness that healthy institutions avoid at all costs.
And the timing? Oh, the timing was just impeccable. This emergency loan happened at the exact moment silver's price was exploding higher. The argument is that this wasn't just some random need for cash. It was a desperate move to cover a massive, unexpected margin call. Basically, the banks betting against silver got caught, they didn't have the cash, and that $17 billion wasn't a loan. It was a confession.
So that was the financial fire alarm going off. But what actually started the fire? That's where we see the paper fantasy market collide head-on with cold, hard, physical reality. Welcome to Section 3, the Physical Markets Rebellion.
Now get a load of this number. In a single, sleepy holiday month, buyers on the COMEX didn't just roll over their paper contracts for cash. They stood for delivery. They said, "We want the metal." Over 63 million ounces of it. This is so far from normal behavior, it's not even funny. We're talking about 8% of the entire planet's annual mine supply being demanded in 1 month from one exchange.
And here is why that demand is a full-blown crisis. You've got over 900 million ounces of paper claims floating around, all supposedly backed by less than 70 million ounces of actual physical silver in the vaults. That's a leverage ratio of more than 13 to 1. It's like a game of musical chairs where there are 13 people for every one chair. The whole thing only works as long as nobody tries to sit down. Well, people are trying to sit down.
And look, this isn't some flash-in-the-pan problem. For 7 years straight, the world has been using more silver than it mines. We've been covering that gap by draining our stockpiles, by eating into our savings. But now, the savings account is pretty much empty. The buffer is gone.
So you're probably asking, where is all this silver even going?
Well, it's being devoured by modern industry at a record pace. Think about solar panels. They now consume over 200 million ounces a year alone. Add in electric vehicles, 5G networks, AI data centers. These industries have to have silver. There's no substitute. They will buy it at almost any price or their multi-billion-dollar production lines grind to a halt. And this right here, this quote gets to the absolute heart of the conflict. The Federal Reserve can conjure $17 billion out of thin air to save the banks from a cash crunch, but they cannot print a single ounce of silver. You can't solve a physical shortage with a financial solution. You just can't.
All right, let's zoom out for a minute and look at the big picture, because when you view all this through a historical lens, you realize that what we're seeing is one of the most extreme market distortions ever recorded. Let's talk about Section 4, History's Unmistakable Echo.
For literally thousands of years, all the way back to the Roman Empire, the relationship between gold and silver was incredibly stable. 1 ounce of gold was worth somewhere between 12 and 15 ounces of silver. It was like a law of nature. Today, that ratio is nearly 50 to 1. That's just wildly out of whack with all of human history. So why? What broke? Well, it's actually pretty simple. Think of it this way. Gold is a collector's item. Almost all the gold ever mined is still out there, sitting in a vault or in jewelry. It gets hoarded. But silver is an industrial commodity. It's like gasoline. It gets used up in our phones and solar panels, and then it's gone forever. There's way less of it available, yet it's priced like it's everywhere.
And here's the kicker. History shows us that when this stretched-out rubber band finally snaps back, it snaps back violently. Back in 1980 and again in 2011, this ratio compressed dramatically, and both times it sent the price of silver screaming higher in just a matter of months. And right now, we are right back in that historical danger zone where a major correction isn't just possible, it's starting to look probable.
Okay, so if you're thinking like a trader right now, you're probably screaming at your screen, arbitrage, just buy the cheap stuff in New York and sell it in Shanghai. Free money. And normally, you'd be right. But that core market mechanism is breaking down. Let's move to Section 5, when arbitrage fails.
So arbitrage is supposed to be the market's cleanup crew. It's this risk-free trade that's meant to enforce one price for one thing all around the world. It's the great equalizer that should prevent exactly what we're seeing right now. Which leads us to the billion-dollar question, or I guess the $6 question in this case. If this is free money just sitting on the table for traders, why is that gap still there? Why isn't anyone closing it? The answer tells you everything you need to know.
And the reason is so simple it's almost stunning. You can't do the trade, because to make it work, you have to actually get your hands on physical silver in New York to ship it to Shanghai. And traders are discovering they can't. The metal isn't there. The arbitrage trade isn't failing. It's working perfectly. It's revealing the truth. There's a severe physical shortage in the West.
And you know who's noticed? The so-called smart money. We're seeing clear signs of capitulation. The cost to borrow silver to bet against its price has collapsed. That means the big, professional short sellers are running for the hills. They are absolutely terrified to step in front of this freight train. The old playbook is broken.
Okay, so let's bring this all home and talk about what this really means for all of us. This leads us to our final section, the Great Monetary Reset. Because this isn't just about a metal anymore. This is about the stability of everything.
You have to understand that our entire financial system is a tightly wound daisy chain of leverage. It's like a giant game of Jenga. A failure in one little corner, like a bank's silver trading desk, can trigger a cascade of defaults across the entire system. You pull out one wrong block, and the whole thing can come crashing down. And this puts the Federal Reserve in an absolutely impossible trap. It's a doom loop. The silver price rises, which squeezes the banks. The Fed prints trillions to save the banks. That printing debases the currency and causes inflation. And what do people do when there's inflation? They buy real assets like silver, which pushes the price up and starts the whole cycle over again. It's a snake eating its own tail.
I mean, you really couldn't have said it better. This perfectly captures the absurdity of it all. They're trying to solve a crisis of inflation, a crisis of currency debasement, by creating more inflation and more currency debasement. It's a strategy that is mathematically guaranteed to make the problem worse.
So the great irony here is that by stepping in to prevent a banking collapse, the Fed has accidentally put a giant safety net under the price of silver. They've sent a clear signal to the market. Don't worry, we will print unlimited amounts of money to stop the system from breaking. They basically created a one-way bet and removed all the downside risk. And that's the final and frankly chilling thought I want to leave you with. The market is screaming at us that the price of silver we see on our screens is becoming a work of fiction, totally disconnected from physical reality. So if that's true for a critical global commodity, it has to make you wonder, doesn't it? If that price is fake, what does that imply about the price of everything else? What is the real price of anything?